Hi, in this video, I'm going to talk about incentive stock options, ISO. So this is employee benefits. So I'm mainly going to discuss in this video. First is what's an incentive stock option? How does an incentive stock option work? How is an incentive stock option taxed when it's qualified? I'm going to show you an example. And how is an incentive stock option taxed when it's not qualified? I'm going to show you another example on this as well. So main source is from IRS website and the tax code. What is an incentive stock option? Incentive stock option is a form of the stock option that is issued under the incentive stock option plan under the section 422, which is a type of statutory stock option. Okay, so first things to point out, this is a plan created by the tax code section 422. And this is called statutory stock option. Basically, tell you those favorable tax treatment of this stock option. The tax treatment basically say if your employer grants you a statutory stock option, you generally don't include any amount in your gross income when you receive and exercise the option. However, you may be subject to alternative minimum tax in the year you exercise an ISO. So one thing to understand is when you are granted and exercise, so you do not pay ordinary income tax on the option. So AMT here, I'm going to discuss in another video. It's less concerned. It's more concerned is if you meet the requirement as a ISO. So let's talk about how it works. What are those requirements required by ISO plan in order to qualify? So first, why you want to be qualified? Because you want to be taxed at favorable tax status, which is long-term capital gain rather than ordinary income as your wages, right? So you want to be qualified. In order to qualify, the tax code requires that you must hold the stock at least 2 years from grant date and 1 year from the exercise date. I'm highlighting here, you have to satisfy both of those requirements, okay? Then both plan and grant have a 10-year duration. So basically, you have a 10 years to exercise that stock option. Otherwise, it's going to be expired. So also you have to understand only 100,000 of the options may be granted annually based on the grant price. Any amount over 100,000 will be treated as a non-qualified stock option. So here, so basically tell you the maximum you can receive is $100,000. So anything above that is not qualified for this long-term capital gain rate. Then also the stock option exercise price is determined at a grant must be at least 100% of the fair market value of the shares on the date of the granted. It's 110% fair market value for the 10% of the shareholders. So basically here, just try to say when you are granted the stock options, the exercise price must be at least the fair market value of the price. Cannot be below, cannot be, your stock option cannot be issued at a discount. If issued at a discount, you are not qualified for the long-term capital gain rate. So that's something they try to tell you here. That's the requirement. So I'm gonna show you how this works in an example. So first I'm gonna show you if you meet the requirement, how your ISO being taxed. Okay, here is a little bit of lengthy example, but you will help you understand this thing well. Let's just go through this example. On March 31st, 2017, when its stock was selling at $35 per share, Apple granted a stock option to Michael, who purchased 1,000 shares of the Apple stock at $35 per share after 1 year of employment. So you can see here is grant date. Okay, granted exercise price $35. $35 is the fair market value. So that's the first thing. The second is the option will exercisable anytime between the March 31st, 2018 and March 31st, 2027. This is between 9 years, but from the grant date to this is 10 years. Okay, 10 years exercise period time. Okay. Mike exercised the option on the May 31st, 2019, when the stock was selling for $50 per share. He sold the shares on October 31st, 2021, when the stock price was $160 per share. Okay, this is selling date, right? 1,000 shares stock option. Then grant date is this March 31st, 2017. Exercise price is $35 is equal to the fair market value. Exercise date is May 31st, 2019, $50 per share, the fair market value. What does that mean, exercise? Which means you bought the shares at exercise price. So that means exercise. So sell date is October 31st, 2021 at $160 per share. Sold is 1,000 shares at this price. Okay, let's look at the holding period. From the grant date to exercise date is over 2 years. Then from the exercise date to sale date is over 2 years. So from grant date to sale price is over like 4 years, right? So you meet the holding period for 2 year and 1 year holding period, both of them. So when you meet the holding period, so your profit is you're gonna be taxed when you sell. At the sale, okay, is this date when you sell. You don't get taxed on grant date exercise. Yeah, you don't get taxed on grant date exercise date. You only tax on when the date you sell. And this sell $125,000 profit, you're going to be taxed as a long-term capital gain. So you have to remember long-term capital gain is taxed much lower tax rate, also have a higher tax deductibles. So you're much favorable than your wage income. So that is how you're being taxed as if you meet the holding requirement. Let's see how you're going to be taxed if you are not meet the holding requirement. Here is exactly the same example. Just changes the date when he sell. Let's say he sold in May 25th, 2020. So the same example, just the selling date is May 25th, 2020. You can see from the grant date to selling date is meet the 2 years requirement. Okay, grant date to sell date is meet the 2 year requirement. However, from exercise date to the sell date is less than a year. You can see it's a few days short for a year. So in this situation, how you're going to be taxed? The profit is the same. However, the tax is from the grant date to exercise this a little gain from $35 to gain to $50. So this is have a $15,000 gain can be taxed ordinary income, but not subject to your payroll FICA tax. So your employer will get tax deduction. So this is tax show up on your W-2. Then third, from the exercise date to the sale date. So this will be taxed at a capital gain. However, because your holding period is less than 1 year, you're going to be taxed at a short-term capital gain. Short-term capital gain rate is the same with the ordinary your wage income. However, this will show up on the Schedule D. So this is short-term capital gain. You may subject to additional the net investment tax if your total income more than $250,000. So that's something different here. Okay, so if you holding period, if you sell the date is from the exercise is more than a year, so you meet the requirement, so you will long-term capital gain rate, right? So you will avoid all those ordinary income tax situation. So you can see the implication on the holding period is very important for you to understand if you have an ISO